Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the show. We have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Very excited anytime I get to talk about index ETFs.
Yes.
Those elegant products that you're slowly coming around to.
Yeah, look, don't get me wrong, I love them too. But look, we are here, episode 2 of our 4-part series on the power of index ETFs. Despite their growing popularity, we think ETFs still have a bigger role to play as we grow wealth over the long term.
This series is an educational collaboration between iShares by BlackRock, S&P Dow Jones, and NAB Trade. If you're looking to invest in iShares ETFs but not sure where to get started, visit blackrock.com.au/iShares for information about their ETF range. Or visit nabtrade.com.au to explore further insights, education, and tips for getting started with ETFs.
So today we are joined again in the studio by Tamara Habanbir, Stats Director, ETF and Index Investment Specialist at iShares by BlackRock. Tamara, welcome back.
Thank you for letting me stay here.
Anytime. You passed episode 1.
Right.
We've now got episode 2. So episode 1 was all about growth. What we look for as investors, long-term investors, is growth. But Ren, today we're concentrating on income and dividends.
Yeah, that's right. I think a particular focus for a lot of investors at the moment, we're seeing interest rates rise and people are rediscovering their high interest savings accounts and also looking for dividends on the share market. And so we're going to cover in this episode the biggest dividend-paying stocks in Australia and the US. We're also going to introduce the dividend aristocrats, if people aren't familiar with that group of companies over in the US. We're going to talk about where you'll find the biggest dividend payers in the index and talk about how with some of these index products, you don't miss out on the dividends from the top end of town. But let's start with some of the biggest dividend-paying stocks. Now, this is based on their last 12 months dividend yield, starting in Australia, the home of a dividend. We love a dividend over here, and we love franking credits to go with it. So, Bryce, what are some of the names that we're talking about?
So the ASX 200 IOZ, we have Air New Zealand taking out top spot, 13.94%. Then IGO at 12.41%. Magellan Financial Group, 10.37%. And Yancoal, 9.95%. So some pretty decent yields there. A reminder, though, that a high yield can indicate a falling share price.
Yes. I think that is a trap for a lot of new investors. Tam, is that something that you've seen over the journey?
Yeah, look, we would sort of think about it at a higher level than how you've described, and I think you kind of explained in the beginning, the beauty of index funds is that you do get the benefits of the underlying constituents. And one of the benefits of IOZ, which is the S&P ASX 200 core ETF that the iShares business issues, is that there are a lot of dividend payers, such as the ones you mentioned, but also a lot of stable dividend payers, not as large as some of the numbers you just mentioned, but the financials, some of the other large materials companies, mining companies, and you do get the benefit. So the ETF, so the exchange traded fund, does get the benefit of those dividends and the franking credits associated with it.
Yeah, so don't just go chasing that highest dividend yield that you'll find on Google Finance because, as Bryce said, if the share price has fallen, the dividend yield starts to look very high. But as you said, Tam, if you're a dividend investor in Australia, you're looking at some of the financials, some of the industrials, some of the other big Aussie companies. We've pulled some of the most common names, and you can start to see that the dividends there are also really exciting, I guess, for investors. So let's start with mining, where so many dividend investors start. BHP, based on the trailing 12 months and share price at time of recording, 4.83%. Rio Tinto just above 5% dividend. Fortescue just below 8% dividend yield. Not bad.
Not bad. So then we've got the banks, Tam, that you spoke about, financials. So Commonwealth, 3.96. NAB was 4.84. Westpac, 5.6. And ANZ, 5.56 as well. So some core stable financial companies there.
And the dividends don't stop there. Woolworths and Coles, the supermarkets, are both in the mid 3% dividend yields. Wesfarmers at 3%, Telstra 4.5%, Transurban 4.7%. So if you're looking for dividends, there's no better place to start than the top of the ASX 200.
Well, exactly. It's certainly not a bad place to start, is how I would frame it. And I think, as you said, we discussed in episode 1 investing for growth. Some of these funds are also providing income. And as you mentioned, IOZ is famous for having a decently high dividend yield in the context of, I guess, global peers. In aggregate, it's just over 3.5% at the moment if we take the last 12-month trailing yield number. Look, that's not to say that investing for income only has to be done by investing in companies that are actually paying dividends. It can be done sort of how we discussed in the first episode, which was around investing for growth, and you could just sell.
Yeah.
You could.
That makes sense.
Yeah.
Some you can sell a portion.
Yeah.
Right, it's one extra step, but particularly when you're looking at a core exposure such as IBV, also has a dividend yield, but it's not quite as high as the Australian market. It's only around 1% or between 1 and 1.5%, 1.3% at the moment, if I look at the last 12-month trailing yield, and other core exposures or other exposures that can complement a core, such as the Global 100 ETF, which is IOO. That has a dividend yield of just over 1% at the moment.
We've thrown out a fair few numbers here, ranging from almost 14% down to, some ASX companies might not even pay a dividend. For someone who's just joined for the first time, who's trying to understand all these numbers, how does it actually work in terms of the ETF paying me a final dividend?
So the ETF, again, the exchange traded fund, pays what is called a distribution rather than a dividend. But the benefit of the companies that constitute the ETF, so the ETF itself receives the benefit of the dividend. The ETF then pays the investors that invest into IVV or IOZ or IOO or whichever ETF you're talking about, a distribution. And that happens, it's different for every ETF, but it can happen either biannually, often quarterly, and in some of our other products, it can happen as frequently as monthly.
Nice. So, if you're an IOZ investor and, your unit of an ETF has a little bit of Woolworths, a little bit of Coles, a little bit of BHP, a little bit of Commonwealth Bank, rather than getting separate payments from all of those companies, iShares by BlackRock does the work, aggregates it all, and then sends it to you.
Exactly.
Pretty easy.
Exactly right. And again, that speaks to the elegance of the wrapper or the ETF vehicle. All of the hard work is done for you. It's one distribution twice a year or quarterly, and it's taking the benefit of all of those constituent dividends and wrapping it up into a neat distribution payment to you.
Why is it, do you think, that Aussie companies love paying out a dividend?
Yeah, it's something that we're famous for. You're right, and we've even got a favourable kind of franking credit system as well, which makes them exceptionally exciting, if I can call dividends exciting.
Yeah, I think you can
Aussies love dividends.
Yeah. But look, it's you're right. It is something that some of the Australian companies are known really well for, even on the global stage. And I think it's returning profits, shareholder profits, to the shareholders, right? It's company profits going back to the shareholders that have supported that company and invested in that company. It doesn't happen every single time. I mean, there have been times throughout history where some of our most famous dividend payers haven't been able to pay a dividend. Well, that can happen as well.
Well, Tam, I think that would be a reminder of the beauty and elegance of an index, because if a particular dividend payer stops paying a dividend, the beauty is, if you're in, take IOZ, for example, you've got 199 other opportunities to perhaps get a dividend.
Thank you, Ren. It's a great look. Honestly, it is a great point to reiterate that diversification within these ETF vehicles means you're not putting all of your eggs into one basket. So you're not only relying on the dividend from the big Australian or your top 4 banks. It's not the case. You do have, I guess, that benefit of a range of sectors, and especially if you're incorporating, as we would argue, is worth considering international exposures such as IVV or IOO, the Global 100, or the S&P 500. There are other sources of company profits that may be repatriated to shareholders as well.
Well, speaking of going overseas, let's take a quick break and then do a similar exercise for the United States, but also introduce this concept of the dividend aristocrats for people who haven't heard of them before.
So we want to say a massive thank you to iShares by BlackRock, S&P Dow Jones Indices, and NabTrade for supporting this series. If you're feeling overwhelmed with what to invest in, which companies to pick, then don't worry, we have been there. With iShares S&P ETFs like IOZ, IVV, and IOO, you can get low-cost access to hundreds of the world's largest companies in a single trade to help diversify your portfolio and to help reduce the stress.
S&P Dow Jones Indices does not sponsor, endorse, sell, or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
Alrighty, well, we've had a look at Australia's leaders when it comes to dividends. Ren, let's turn our attention to the US. Who are we seeing as the big dogs over there?
Yeah, well, I mean, we can do the same exercise that we did in Australia and start with just looking at the trailing 12-month dividend yield. And again, this is based on the current share price. So if a company's share price has fallen, the dividend yield looks perhaps a little nicer than it is in reality. But some of the bigger names over in the States at the moment in the S&P 500, which is the IVV ETF, we have Altria at 8.51%, Verizon 6.69%, AT&T 6.46%, Crown Castle 6.43%, Ford 6.41%, and Healthpeak Properties 6.05%. A couple of names there that are quite familiar. Ford, AT&T, Verizon, probably household names. Some that aren't, Crown Castle and Healthpeak, and then one that's certainly a household name in your house, Bryce, Altria Group.
No, not at all.
For people who are unfamiliar, they own the tobacco company Philip Morris.
No smoking over here. So, Ren, you mentioned dividend aristocrat. So let's introduce the term. What is it?
Yeah, so it is a impossibly hard club to get into. Well, it's a difficult club to get into, and yet 67 out of the 500 companies in the S&P 500 at the time of recording are in there. To make the cut, to be a dividend aristocrat, you must, first of all, be in the S&P 500. That's a prerequisite. And then you must have increased your dividend for each of the past 25 years. Not just held steady for some of those years, but increased each of the past 25 years. It blows my mind that 67 companies in the US have made that cut. To put that in context, that's 13.5% of the index have raised their dividend every year for the past 25 years. I don't have the numbers in front of me, but I know some of these companies are like in the 40 years that of just raising their dividend. Like we talk about the stock market being unpredictable and volatile in the short term. We talk about business being hard. These companies just keep grinding it out. So, yeah, it's impressive. And the good news is if you just invest in the overall index, you get access to those companies.
The point here, Ren, is that indexes are full of great dividend-paying stocks, many, though, of which we haven't heard of before. 67 dividend aristocrats. Tell me this, have you heard of Aflac?
Aflac, no. Ben Affleck, yeah, he's pretty
Okay. Have you heard of Becton, Dickinson and Co?
No.
Okay, what about Church and Dwight?
Honestly, you could just read the list because you know what the answer's going to be.
I mean, there's some big names in there: Coca-Cola, Colgate, ExxonMobil. So there's some really well-established IBM, Johnson & Johnson. These are companies that are well known, top of the index. But again, the great nature of how these indexes are structured is that we're getting access to some epic dividend-paying stocks that are very unknown.
Give us a couple of more unknown ones to make that point.
Okay, Nordson Corp.
No.
Nuka Corp.
No.
Sherwin-Williams.
Oh, yeah, paint.
You didn't know that.
What
really?
do you mean? Tam, you familiar with that one?
I'm not, but I think the overall point that you're trying to make is the universe is large. Some of them pay dividends, some of them don't. The good news is though that both in the States and locally here in Australia, you can, if you so wish, invest in targeted dividend-paying funds, like for example our IHD. Dividend Opportunities Fund, which is also tracking an S&P index.
Nice.
So, look, the choices are there. You are certainly getting them in the core exposures, but if you want to get more granular and target just dividend-paying stocks in particular, there's options for that also.
Yeah, we see some of our community doing that, wanting to weight a little bit towards ETFs, particularly as they get a little bit older in life and want to use the income to actually support their lifestyle. So yeah, there are certainly products out there that are weighted towards that.
I think the final point we want to make as we wrap up this episode on income is why most of the big dividend payers generally can be found towards the top of the index. And it's because when companies are young and dynamic and fast growing, they're generally taking their profits and reinvesting them in the business. And what we generally see over the business cycle is it's more the slower growing, more established, mature businesses that take a greater percentage of their profits and pay it out as dividends. And hopefully, if they've done things right and they've grown well at that point, they've made it into these indexes, the ASX 200 or the S&P 500. And I think the classic example that with a company we're all familiar with is Alphabet, which is the parent company of Google. Google listed in 2004. It had 20 years of incredible growth as a share market listed company. It wasn't paying dividends though. It only started paying dividends this year. And you can bet that it
certainly could have paid dividends.
Yeah, but it had things to reinvest in, self-driving cars and search ads. But, now it's right at the top of the index and it's paying dividends for its patient investors. Yeah.
So Tam, any closing thoughts, I guess, on how we should be thinking about income as part of our portfolio as we're thinking about core and satellite and building something for the longer term?
Yeah, absolutely. I think, again, going back to that core exposure at a low cost, whether it's for growth or it's for income or a combination of the two, I think, the elegance, again, is that you are actually getting all of those features in some of these core exposures, such as IVV or IOZ, or complementary exposures such as the Global 100 ETF. That's it.
Nice.
Yeah. Well, I think that just reinforces the point of this series, which is with indexes, you don't miss out. There's a bit of growth, bit of income, whatever you're looking for, they might be right for your needs.
And we're loving seeing the Equity Mates community submitting their portfolios as part of our Pimp My Portfolio segment, and seeing so many index ETFs in there making up their core portfolio. So, certainly on the right track when building the core. We would like to say a massive thank you to iShares by BlackRock, NabTrade and S&P Dow Jones Indices for supporting this series.
Are you looking to invest in ETFs but not sure where to get started? Visit blackrock.com.au/iShares for information about the iShares ETF range available in Australia, or visit nabtrade.com.au to explore further insights, education and tips for getting started with ETFs.
S&P Dow Jones Indices does not sponsor, endorse, sell or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making an investment decision, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
Well, Tam, we want to say a massive thank you for joining us for this episode and the last episode. I hope you've enjoyed your time on Equity Mates.
Most enjoyable. Thank you
Open
both
invitation.
for having
Yeah.
me. No, really appreciate the time.
And next episode, we're going to be talking about cutting your losers, and we're going to be joined by an expert from S&P Global, Sue Lee. So make sure you subscribe to Equity Mates and you tune in next week when we speak to Sue.
Love it. Well, Tam, thank you so much.
Thanks, Bryce. Thanks, Ren.
Thanks, Tam.
Equity.
minds.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.